you just mentioned that kind of coming into this year, you mentioned a couple of ETFs there, and we'll sort of explain what those are for folks, because those are ETFs that let people go short or long the markets on a leveraged basis. And levered long ETFs, and we get a chart here that you put in one of your recent writings. You show that they increased 4 times, from about 10 billion to 40 billion. It's come off a little bit now this year, obviously, because we've had this market drawdown this year, but it's still historically very elevated. And as you just mentioned earlier, in just June alone, we had a 2x increase in the leveraged short ETF volume. So my question is just sort of, I'll let you opine any way you want, but there sort of seems to be this swing for the fences mentality that the retail investor is pursuing here. What does that mean for market stability to you? I mean, is this a very dangerous thing?
I think it's absolutely dangerous. I think, there's been some interesting work done demonstrating the magnification that retail investors have had on stock prices by way of leverage. And we've never seen a bear market driven, by the amount of options activity, leveraged ETFs. All these things are new, right? The last time we had a major bear market, 2008, there wasn't this retail activity on the options market. We didn't have leveraged ETFs to magnify these things. And so I think this is a concern, and it's something that I paid close attention to, because I think we saw in early 2018, the Volmageddon episode, where the short volatility trade imploded. And that was something guys like Chris Cole, were kind of writing about in a couple of years leading up to that, and saying the popularity of these short vol ETFs is going to be problematic at some point. It happened, it blew up in 2018, essentially overnight. And I think this options trade has the potential to be something similar. When you have billions of dollars of call options purchased on a Wednesday that expire Friday, right? You have market makers end up being short call options. They have to hedge that position by buying the underlying equity. So what happens is you have retail investors can put just a little bit of money to work, and that forces a lot of money to be put to work in the equity markets, which can magnify the upside. I think there's potential to see this if we see the next leg down in a bear market and retail investors really get into put options. You can see this work in the other direction, right? Where retail investors buy tons of put options that are deeply out of the money and expire, weekly options expiration. So they expire on a Friday, they're buying them Wednesday. And they're spending a tiny little bit of money, makes market makers short a put option against the stock. They have to go sell stock to hedge that position. And that's a potential dynamic that's out there that could make for, it could exacerbate an underlying decline in equity prices. And that's something I don't think regulators are paying enough attention to right now.
If you enjoyed this video clip, click here to watch another one you should like.